Hey guys, welcome back. So in a previous blog post, I talked about TradFi versus DeFi, and I used Twitter as an example. But today I thought it might be interesting to do something similar, but using the SPY ETF. So let me make sure everything looks okay. So I wanted to talk about how the Tastyworks portfolio margin, which represents the TradFi side, stacks up against the Terra ecosystem, the Anchor and Mirror protocols, and to see how the how the rates differ um, and and how to see like if one is better than the other, or if it's up to your own personal risk reward preference. So let's go with the Tastyworks TradFi side. I'm going to sell a SPY strangle using portfolio margin. One thing to note is like that the buying power effect that you see over on like the lower right hand side. I think that might be like a bug, or because I think they had like a recent update, and I'm not sure if that messed things up a little bit, or if they're really being nice, which I doubt. Um, I mean, you only have to put a $592 buying power to control a roughly $431 dollar ETF, which is about $43,100, which seems a little bit crazy to me because like if you look at how much um, I'm collecting 589, which is almost the same as a buying power effect. So that, I mean, 100% return on capital seems really too good to be true. So my guess is that, um, I mean, like I guess like the way the Tastyworks portfolio margining system works, it can give you up to 6-to-1 margin. Sometimes I've seen it as low as 4-to-1. So let's just say conservatively, if I get like 4-to-1, then um, my real buying power effect is probably like 11,000. So that's just something to keep in mind. But for like the rest of the example um, in this video, I'm gonna just assume 592 is correct, even though I don't think it is. But I just need like some numbers to work with. So I've already populated a table over here inside the PowerPoint, just to illustrate how much you could potentially make. Um, so I'm selling a strangle in the August 27th expiration cycle at the time of this recording, and then that gives me like about 41 days left to expiration. Again, I think the buying power is a little bit off. Um, I think it might be a bug somewhere. So I'm collecting $123 on the 448 call, and then I'm also collecting $466 on the 414 put, and that gives me $589 dollars up front. If by expiration it doesn't cross 448 on the upside or go below 414 on the downside, this is mine to keep. So this is where the greedy scenario, the return capital is if I try to keep the entire 589. Most tasty traders don't think that's a good idea, because if you get breached, um, it could be really painful if you're selling a strangle. Again, these numbers are probably overinflated. So I mean, it's kind of crazy. You get almost 100% in 41 days, and if you annualize that to 365 days, that brings it up to like 886%, which again I think is overstated. It'll probably be around 148%, just based on my calculations. So let's see, what else can I uh, share with you? Again, the buying power effect is probably somewhere between 6,900 to maybe even up to like 14,000. It depends on how the markets move, if there's a big shift, your buying power can increase dramatically, especially if you start off at a really artificially low amount, 592. So, I mean, I guess in real life, if you ever get this, you might want to take advantage of it, but maybe on a small trade, because if it turns out like that you actually owe more, or you need to put up more cash, that could be really painful. You might get kicked out of your positions artificially early. But anyway, what most people do on when they trade the Tasty Trade way on Tastyworks is they try to close out the position at 50% profit. So 50% of this 590. So roughly if you're collecting around 295 to $300, if you see that as your open profit, just take it. This way you can take the money and recycle it into other positions. Um, so so again, this is a very optimistic number. You get roughly 50% in around 20 days or so. So the rule is you try to collect that either 50% profit or uh, after like 24 days or so. Um, Again, this number is overstated. It's 165% in this example, but in real life, it's most likely a lot lower. And again, I'm putting the assumption that I can close it out at, tw- at either 20 days, at 50%. Use these as like ballpark numbers. I'll never be exactly, um, you know, 24 days or 20 days or whatever, or it'll never exactly be 50%. Just you just use your judgment. If you get like 45%, just take it. Well, or in my opinion, like that's what I would do. So but let's just assume even at even if we're being like the least optimistic scenario, if you can get 50% a year just selling strangles and spy ETF, I think a lot of people would be extremely happy. In real life, you'll probably fall a little bit short because you have to account for or losses and things like that. So that's just something to keep in mind. So let's go over to Terra, the mirror protocol. And what I'm showing here is a different type of farms that you can do on the Terra ecosystem. So they have Bitcoin, Google, Apple, Amazon, uh, the triple Q ETF, the gold, uh, and SPY. So I wanted to try to do like a apples to apples comparison. Um, right now, the long form is not. I've seen this at a higher number, but again, these numbers change depending on like supply and demand. So right now, it's paying 19.67% at the time of this recording on the long side, and then on the short side is like 0.61, which isn't that great, but it's still better than a bank account. So again, your mileage may vary depending on when you get in. So I just want to show you real briefly Terra Mirror Protocol, the mSPY, the like I guess a few screenshots on how to do the long. So the way things work in DeFi is that you can't just like put in um like one. Generally speaking, most protocols require you to put up like a double-sided liquidity pool. So basically, you have to put in two assets at 50%. So in other words, like equal value. So like for example, um, so let's say I only want to put up like a $50. So I would put like $25 worth of like this mSPY and another $25 here to make the positions equal. Over time, like the, the the values of each asset will change depending on how people want to buy things. Um, and the cool thing about like being a liquidity provider on something like this is it's almost like being a exchange member on like say either a like the stock exchange or like any type of like formal TradFi exchange where you can actually get a piece of like the trading profits directly. Whereas like in TradFi you have to like the closest you can do is um, buy like the corresponding stock and then wait for like a quarterly dividend. And like at today's recording, like most of those exchanges only pay out like maybe like 1% dividend, which is I think you have to put up a lot of money to buy the stock, and then only to get 1% dividend is not that great. You're usually hoping for like a lot of volume so that the stock price can go up, but that's not like as dependable. So if I go to the next side on the short on the short form, it works very similar to how you would do it in a regular brokerage account. So first you have to borrow um, somebody else's shares, then you sell it, and then you collect the dollar amount, or like I guess like the fiat amount. So then, but in like the DeFi world, usually you have to put up some type of collateral to do it. In this case, in the Mirror protocol, you can either put up regular UST, which is like the representation of like the US dollar, or you can use something what they call AUST. So the way to think about it is this: their banking protocol is called Anchor. So if you deposit like money in there, like you can get like around like 20% interest, which is pretty good. But it kind of works like where like in a bank, if I go to like a normal TradFi bank and I deposit some money, normally they would give me some type of receipt, either like like a physical paper copy or like a like a some kind of like entry within like my banking app saying that, oh well, I have this amount of money on deposit. And what you could do is like you can actually like in the DeFi space, you can actually take like that receipt and you can borrow assets against it, which is pretty crazy. But there is a catch though, because you have to over collateralize, meaning you have to put up more money than what the asset is worth. So in this example, I use my AUST, which I got from depositing money in the Anchor protocol. At the time of this recording, you know, I I'm putting up $275 of this AUST, and I'm collateralizing it at 200%. I can actually borrow 0.34 worth of mSPY, which is the Mirror Protocol's like version of like the SPY ETF. So it's like a synthetic. Um, One thing to note for the collateral ratio, even though your minimum was only 130%, like my personal preference is always over collateralize as much as I can, just so like I don't get kicked out of my position early. So I just put in like 200% just to just to make my life a little bit easier. But you can feel free to play around with like the collateral ratio on your own time. So here's the interesting part about the mSPY proceeds. So I borrowed like this amount of mSPY, and then what happens is it automatically sells it for you. So I'm actually getting back $146 in UST, which I'm gonna like deposit back into Anchor so I can earn like 20% interest. So it's kind of like it's a little weird because in like normal like short selling, like say if I use like Tastyworks to do it, I can't earn interest. Well, actually, I do technically earn a little bit of interest, but the amount of interest that gets paid to me isn't that much. But imagine if like I could use if I could sell short in a regular brokerage account, but then transfer like my money to like a bank that pays 20% interest. Like that's basically what you're doing here. And like the fee that I paid was like like 15 cents. So this is something worth considering. Not financial advice, of course. This is stuff I'm just showing you guys like what's out there, and if you choose to do the same, great. If you don't, that's fine too. This is just more so you can get educated, so before you make any decisions. So I just want to show a screenshot of what like the Anchor. Oh, actually, I'm sorry. This is actually it should be Anchor protocol. Sorry about that, but I'm gonna fix this right up. Save it, and then so well, technically, I guess it wasn't wrong. I was using the mirror protocol, but I'm also showing like the Anchor deposit. But I think this is probably better. So right now, like on any UST, I'm getting 19.47%, which is pretty close to 20%. And it's amazing how they're able to do this. Like they actually take like the fees, like for example, that 15 cents that I paid earlier in Mirror, like throughout the whole system. They're collecting that money within the ecosystem so that they can pay out. That I mean, that's how they're able to pay out such generous like interest to like I guess like early customers. So I guess like again, this is not financial advice, but I mean this is really hard to pass up because like normal banks are not gonna give you 20%. So that's what I'm doing for like a small amount of my money, and now I just want to show kind of like the results of like how everything will work out. And the reason why I chose like a weird amount, like let's say 0.34, because in the TradFi example on Tastyworks, like the buying power effect was supposedly $592. So I wanted to come up with like for both the long and the short farms, like a similar amount in total of what I have to put up to equalize that. Um, so like 0.34 mSPY is $148. So or the dollar equivalent, and you have to do it on both sides for like the farm. And like based on that earlier 19 percent on the long farms, like I'm collecting $29 on each side. But it's paid out in the mirror protocol, but you can always that mirror protocol like crypto that you get what you can do, you can stake it again within the mirror protocol, or you could just sell it for UST and redeposit the money back in the Anchor protocol. I mean, it's basically up to you. I don't think there's a right or wrong answer there. Unfortunately, on the short side, like the amount of interest that you get is only works out to be 90 cents. So it's not that exciting. But I think the more interesting thing is because I guess this is just my own thing where because I already put up $275 worth of AUST, I'm actually going to subtract it out of my own like buying power effect for purposes of like return on capital calculation. But you can, uh, I mean, I guess like if you feel comfortable, you can like actually flip the signs here and actually call it plus 275. Um, because I already collected $146 um, from selling short the mSPY. So I guess like there's like some room to play with like on your own personal. If you want to be more conservative, you can make this minus 275 as a positive. Um, so it'll actually be a little bit more of a buying power effect. It's up to I guess like how strict you want to be in terms of like your return on capital. Return on capital. But for myself, I'm gonna use 315 as the as kind of like the base to like the amount of capital that I'm tying up. Um, and then I guess like the other way to do is like you make this like positive 275 and then to make this one negative 146. It really is, I guess it's up to you how you want to do it. So like if I deposit it back into like the Anchor protocol again, I could collect about $28.53. And then so in total, I'm collecting $87. So if I divide this by the 315, I get a 27.78 return on capital. Again, this is just how I'm personally choosing to calculate this. And then the other things to keep in mind is you have to over collateralize before you borrow any synthetic stock. And then this is assuming that you also deposit like your proceeds from the short sale into Anchor. So that's something to keep in mind. And then like some more caveats. Even though like the Tastyworks, like the return on capital is a lot higher, you're taking up more risk, and then you're also putting up a lot more money. So like the portfolio margin on Tastyworks, like you need $175,000 to start, and then you need $150,000 to maintain like all your positions and to maintain your portfolio margin privileges. And then another thing to really keep in mind is like buying power effect. I mean, it could expand a lot during huge moves. So I would say like the Terra protocols in total, it could be more friendly for small accounts. Um, and then like both methods like I think it can take some getting used to. Like most people are a little bit afraid of options trading, and then also like a lot of people also afraid of like crypto and DeFi, and rightfully so. I mean there are definitely risks, but with more risk you get more reward. So hopefully everything works out for the better for you, and I hope you have like good results in trading. Um, so in terms of like which is better, it depends on what type of trader you are. I guess like if you want like at least for now like a higher return, Tastyworks portfolio margin is the way to go. But you have to have a relatively large account, um, and it's definitely risky. And there's like but again, higher risk, you have higher return. Terra is also, I mean, I guess it depends on how you look at it. To me, it's not as risky because you can put lower amounts of capital to work, and it is DeFi, so there is a chance that if there's a bug in a code somewhere, someone can either do an exploit or a rug pull or do something crazy creative to like siphon off funds somewhere. So there is that risk. Um, so you can use your experimental money or like risk money to like start smaller positions and see how it works, and then kind of scale up from there. And then what I really like about it, like I guess like in DeFi, you can earn more money on your idle cash, whereas in Tastyworks, you have to kind of find like a maybe like a stock or ETF that pays out like a dividend or some interest to like to kind of put like the money that you're not using in a trade to work. And then you have to like kind of like um, do more transactions to if you want to take it out of a dividend paying stock and put it to like a more um, higher riskier stock, but like maybe with more return. So there's no, uh, I guess technically no better. I guess it really depends on how like your risk and reward preference. Like for example, for me, I'm putting more, at least for now, more money into Tastyworks options trading for now. But that could change as I found more interesting DeFi protocols like Terra Luna, Terra Anchor, and Terra Mirror, like these protocols. There's a lot of potential in here. So like over time, I could see myself going like 50-50, and then like maybe even in like when all the systems mature, like I might actually be in like more than like close to 100% DeFi. Like I'll probably leave like some in like TradFi just to like pay bills and things like that. But anyway, hopefully you guys found this interesting. Hope you guys can give me a like and subscribe. You can feel free to check out like other articles in my 0x publish blog. So any like viewership, is greatly appreciated, and I just want more people to learn about this. You don't feel like you have to be locked into like the kind of like the old ways of doing things. The new ways of like finance are very interesting. So definitely check it out. Even if it's not me, like there's so much like interesting content out there regarding DeFi, and I hope to be one of your trusted sources for that. So thanks everyone. Thank you, and I hope you have a great one. Bye now.